The structure of this presentation is going to be broken out into basic fundamentals of supply and demand with details on each. We're going to start by giving the U.S. production outlook for this summer and conditions beyond this summer. We'll then round out the supply side of the story by focusing on how much we expect the United States to import from Canada, again, both this summer and beyond. At that point, we'll give a snapshot of where lower 48 working storage gas inventories stand at the moment and at the start of the summer. And then we'll move into the demand side of the equation. We'll start by looking at demand projections and forecasts for the lower 48, the impacts that we expect to see on gas burn from coal retirements and the growth of renewables. And then we'll also round out the demand side of the equation by looking at how much the United States will export to Mexico, again, this summer and through the future. At that point, we'll provide a quick summary of some infrastructural changes that are occurring in the market and give you our assessment of their impact. And then we will wrap it up by giving a look at where we expect lower 48 working inventories to end the summer season and the impact that may have on macro and regional basis prices. So with that, I'd like to hand it over to Randall Collin to discuss our production outlook.
All right, guys, we're going to start this off by offering a quick poll question, so please submit your answer, and we'll look at the results and talk about those and talk about where our point of view is on this subject. All right, and I see on here that the rig counts are pretty evenly broken out between when people think they're going to bottom. Our point of view is that we think they will bottom in Q3 in August, and we actually think they will start rebounding from there as the contango in the crude market, the prices go up, which will in turn drive the economics up for oil drilling, along with cuts in cost will also help motivate the rigs to get out there and start drilling again. So we actually think Q4 you'll actually start to see a decent little ramp in oil rigs. So once again, Rick said, my name is Randall Collin. I'm the Managing Director of Supply Analytics here at Genscape. I'm going to spend the next 4 or 5 slides just talking about our production outlook, our point of view, and let me get started. Let's move on to the next slide. So the big thing that's really gone on since last August that's impacted our production forecast quite a bit is the drop in both crude and natural gas prices. As you can see on here, April 2015 is trading about $50 lower than it was back in August, and natural gas is trading almost $1 down. And the way we built our models here at Genscape is our rig-based models are built off of economics and off of these forward curves. The one thing that's helped kind of keep production propped up even as rigs have already been dropping is the deferred inventory that's been built up from pad drilling over the last year or so. So it takes a while before that price actually impacts the production. And right now we're seeing about a 5 to 6 month lag between a price impact and a rig impact, and then another 2 to 3 months, sometimes even 4 and 5 before we actually see a production impact on that. And using those future curves that we showed on the previous slide, this is just a slide here comparing what our forecast was before prices dropped to where they're at right now. And as you can see on this graph on the left, our production forecast by the drop in oil and gas prices is down almost 7 BCF a day by 2018. We are currently calling for production to peak in the May and June time period. That gives us about, an 8 month lag between when rigs peaked back in, I guess the 7-month life between rigs peaked back in the end of October. For this summer, we're thinking we're going to see around a 3.3 BCF a day year-on-year increase. It's slightly lower than last year's summer increase, where we had a 4.3 BCF a day year-on-year increase. Things are starting to slow down in growth in the Northeast, as we've only seen a 1% increase in production since December. At this point last year, I think we were closer to 7 or 8% or so. Like I said, we think production will peak here this summer, and that's as some of the deferred inventory that had built up gets eaten away. But also potential risk to the downside of that is actually producers deferring even more completions, and we have a slide that we'll show here in a few slides. Right now, there's already 700 wells that are announced that will be drilled and will just be intentionally deferred due to the contango in the oil market. I wanted to show a slide here just comparing our rig declines that we saw back in the last big downturn, which was 2008, 2009. Interesting side note is that both peak rig counts were in October of the previous year. So October 2008 was the peak rig count back then, and October 2014 was the peak rig count now. And as you can see, they've followed quite the same path from a decline standpoint on a percentage basis. And the last time around, prices rebounded so quickly that the rig count declines ended at about 30 weeks. Right now, we think the rig counts or declines will end about 41 weeks, so another extra 2.5 to 3 months on top of the rig declines that we saw back in 2008, 2009. Now that's due to change. If prices, for whatever reason, decided to rebound quite a bit over the next month or two, you would start to see that slowing down even more, and maybe even turn around before then. But last week was the first rig count week where we actually saw, in the rig data, we saw a 2-rig increase after the last 13 or 14 weeks averaged almost 75 rigs a week decline. You know, and people, you know, we've read this over several articles the last few years that rig counts do not matter. We're a firm believer that they do matter. And this is just an example. We wanted to show Texas historical production data when we had peak rig counts and how long it took for it to reach its peak production level, and kind of what our current forecast is for Texas. And this is a snapshot of why we think we'll see lower 48 gas production actually peak this time around. In 2008, 2009, there wasn't as much pad drilling going on, but we saw rigs peak in Texas in October there, and production peaked there in January before it started to decline, and it actually declined about 2 BCF a day over the next year. This time around, we saw rigs peak back in, I think, the beginning of November for Texas, and we are calling for about a 6-month lag between rig peak and production peak, and that's because this time around we do have pad drilling, which has built up a natural kind of deferred inventory that those wells will have to be completed as part of the manufacturing process. So you will have production lasting longer than what we saw previously. And you know, lower 48 production has not hit a peak in the last several years. It just keeps going up and up. The reason we think this time is different is because even though in 2009, when Texas production started declining, we had Haynesville Shale for the next 3 years pick up the pace. In 2008, operators were spending crazy amounts of money on leases, 30 grand an acre. They were signing 2 to 3 year leases when typically they were 5 to 10 year type leases. So the producers had to go out and drill those wells, and they ramped up production quite a bit because of that, because they had to hold those leases by production. So it kept lower 48 production propped up through 2011 when the Marcellus and Utica were discovered, and then that kind of took the place of that, and that kept production growing. 2013 was really a minimal growth year, only like about a BCF a day. We had seen gas rigs come off in early 2012 with gas prices. However, that Marcellus and Utica just kept it propped up and going. Now we're starting to see Marcellus and Utica rigs drop. We've seen over 30 rigs in that area drop here recently. We've started to see some processing plants get delayed in several regions across the country. So we actually think all this is adding up, and there's no new production sources that are going to help keep production from declining here at some point this year, we believe. So unless, you know, even if if Marcellus and Utica surprise the upside. Next year, right now, we're calling for about 1.5 billion of production declines. We think absolute upside, we still decline, 400 to 500 million a day year on year, and we still think there's quite a bit of it's a high probability we'll have declines next year. And I mentioned earlier in the slides about our deferred well inventory we've seen announced in the quarterly conference calls here recently, and these are the 720 wells or so. We've seen Apache in the Permian Basin, SM Energy, mainly in the Bakken. I've seen EOG, Chesapeake, and Cabot in the Eagle Ford defer wells. And when they defer wells, combined with the $10 contango in the oil market over the next 10 months, and completion cost, assuming that those come down 20%, it actually improves the IRR on these wells. When these producers have rigs under contract, so they have to run the rigs, it's going to be a sunk cost otherwise. So they just decide to go ahead and drill these wells, and they will complete them when the economics suggest they should. They do not have these completion crews locked in under long-term contracts like they do on the drilling side. And right now, just these 720 wells alone being deferred equates to about 450 million a day of gas if all those wells are brought online in 1 month, and it equates to about 370,000 barrels of oil a day. Basically, these deferred wells, from an oil perspective, are acting as storage. So as Cushing gets full and the U.S. producers can't export oil, in turn, they're turning these deferred wells into a type of storage, and it actually improves their economics as well. So just wanted to make this point out that if more of these get done, you could actually see lower production over the next few months just due to actually deferring more and more wells if the steepness in the contango encourages that, continues to. And now I will pass it back over to Rick, and if there's any questions at the end of the webinar, I'll be happy to answer those.
Okay, thanks, Randall. Yeah, and I probably should have mentioned at the outset that there is a question panel over in the GoToMeeting bar that you can input questions, and if we have time, we will address those at the end of the webinar. So the production story was pretty clear. We're looking at about 3.3 BCF per day of incremental growth this summer versus last summer. Just want to round out the supply side of the story by looking at how much the U.S. will import from Canada. Over on the top right, you can see that Western Canadian production actually ended several years' worth of declines and saw a bit of a rebound. Genscape Spring Rock is forecasting declines through the rest of the year, but then another period where production does begin to stabilize again up there. If you're a Canadian producer, the bright spot is that Western Canadian demand is growing. However, that pace of growth still is not catching up with how much is produced out of the area, which basically means that Western Canada continues to be reliant on exports. And until some sort of LNG export market gets developed, that means that those exports are going to have to move to Eastern Canada and the United States. Moving gas out of Western Canada into Eastern Canada and the Midwestern U.S. has become increasingly difficult. And because of that, we expect that Canadian exports to the U.S. on the whole will be lower this summer. This summer, we are forecasting the U.S. will import 4.8 BCF per day from Canada. That would mark a 0.2 BCF per day summer over summer decline. The exception to that, however, should be noted is with regards to Western Canadian flows to Western U.S. markets. There's a little bit of demand growth that we expect to occur in the Western U.S., primarily due to the hydro situation, which I'll talk about here in a moment. But the economics still work to move gas from Western Canada into the Western U.S. The pipes moving gas out of Alberta via foothills and the gas moving out of BC via West Coast look to be sufficiently contracted. So that will be an exception. But overall, we expect a decline of 0.2 BCF per day, summer over summer. So what this effectively means is that from the U.S. supply situation, we will be looking at a total of 3.1 BCF per day more supply. from production and lower imports. Okay, so having rounded out the supply side of the equation, we wanted to get into demand. Shortly before we do that, we do have another poll question. This one is with regards to the storage. So we'll go ahead and we'll post that poll question now and give folks a few seconds to answer that. Okay, so with that, let's go ahead and look at the demand story, starting with storage, because certainly much of the gas that's going to come out of the ground is going to go right back into it to help refill storage inventories. As you can see in the black line, right now storage inventories are sitting just around 1.47 TCF in lower 48. This week we are forecasting a 12 BCF injection, which would mark the first injection of this year. It's a little bit earlier than normal, but not terribly so. And then for 2 weeks out, we forecast basically an equal size withdrawal. So what this means is that at the end of the winter season, we expect to see inventories at right about where we are right now. Putting this in the context of recent years, this is pretty close to, it's actually just a little bit shy of the 5-year normal, but not extremely so. And it is substantially higher than, of course, where we entered last winter. So there's a pretty decent amount of gas in storage to start the season, and that's going to be important to keep in consideration as we round out the demand story with the supply side. So let's go ahead and we'll look at demand. And right now, the big story for the summer is the amount of gas, incremental gas burn that people could expect from the large slate of coal retirements. Throughout 2015, we are estimating 27 gigawatts of nameplate capacity on coal units in the United States will be retired. Dissecting that into the summer, we estimate about 18 gigawatts will go off during the summer period. And as you can see in the chart on the left, the bulk of these retirements are occurring in the PJM area, followed by CERC and MISO. I think if we were to replace those coal units on a one-for-one basis with natural gas, certainly we would get a pretty large number. But what's important to keep into consideration is that the coal units that are going offline have not been very heavily utilized in recent years. The chart on the right shows capacity utilization at those units that we have slated for retirement in 2014. And basically what this shows is average utilization across that to-be retired fleet was just 26% of nameplate capacity. So in effect, most of the capacity has already been idled. And so this is going to diminish somewhat of the incremental gas burn gains that could be grabbed from these coal units going offline. But nonetheless, we do have retirements that are going offline, and some of this is going to get replaced with gas. If we factor in the utilization rates of those to-be retired units and factor in heat rates on gas plants in areas surrounding those units, we estimate that the incremental burn from those retirements will generate just shy of 900 MMCF per day of new gas demand this summer. Over the course of the year, because some of those retirements are scheduled to take place beyond the summer strip, the total number gets a little bit higher to just over a BCF per day. So there is incremental burn opportunities that will occur from those coal retirements. The number may not necessarily be as robust as if the utilization rates on those plants were higher, but nonetheless, demand growth is demand growth. That said, not all of that capacity will be taken up by gas. There are other opportunities for increased gas demand. One of those areas that I alluded to earlier is out west. For those that do not follow Western power markets, hydro is a very big player in the supply stack out there. And hydro is not really expected to show up in force this summer. This winter was very bearish for gas demand in the west and particularly the Pacific Northwest. While precipitation levels were normal, temperatures were above normal, and so that not only quashed gas demand for heating applications, but it basically took those normal precipitation levels and immediately converted them into hydro generation and runoff. So that pushed gas out of the winter power stack. However, what that also did was it prevented that precipitation from turning into stored energy in the form of snowpack, and as a result, we are looking at a summer of hydro runoff that is potentially quite low. And so what we tried to do was figure out how much gas demand this low hydro summer that we're expecting would create. And what we did is we started by looking at flows through the Dalles Dam. The Dalles is a pretty good bellwether for dams throughout the West. And we looked at 30 years of flows and pulled out 3 representative years that represent low, normal, or average, and high hydro years. Next, what we did was we looked at the Northwest River Forecast Center's estimations for stream flows in the region this summer. And what we see is the expectation that this summer is probably going to be somewhere analogous to the low hydro runoff scenario that we've seen in the past 30 years. So the next thing that we did was we used Genscape's WEC terminal to pull gas generation in those years where hydro runoff through the Dalles Dam was very low. And what we see was that in analogous low hydro years, gas burn in the entire WEC region, so this is not just the BPA or Pacific Northwest, but the entire WEC region burned about 5.3 BCF per day in low hydro years. In an average hydro year, the region is burning about just over 5.1 BCF per day. So what this means is that in a low hydro year, you can expect to see about 0.12 BCF per day more gas demand than you would in a normal year. So that's how we're getting to our estimate of that growth. One thing I do want to point out, however, is as you can see on the chart on the right, the hydro season really only runs through the end of July. Beyond that, we basically start getting back into normal conditions, and as a result, what this means is that incremental 0.12 BCF per day of gas burn is only going to run through July. By August, September, October, we do not expect any incremental burn from the hydro conditions in the Pacific Northwest. Next, I want to talk about the sort of a contrary scenario. So while we expect to see some growth in gas demand to replace the coal retirements, and we expect to see some growth in gas demand to offset the low hydro, we also expect to see some lower gas demand as a result of the growth of renewables. This year, for the entire year of 2015, there's going to be over 25 gigawatts of renewable generation capacity installed. Most of that does take place towards the back end of the year. For the summertime, however, there will be over 6 gigawatts of wind and solar capacity added into the market. So when we account for this and we look at utilization, typical utilization rates for utility scale wind and solar, what we see is that as we start to get towards the back end of summer, the growth of those generation sources could actually disincentivize gas demand and cause gas demand to retract somewhat. So over on the right, when we take all of these considerations into account, when we take into account the growth in gas demand from coal retirements, plus the growth from higher hydro, minus what would be lost due to the growth of renewables, we do get to a little bit of a larger incremental summer-over-summer gas burn number. All these sources combined could increase gas burn by about 1.1 BCF per day through August. After that, we're basically looking at flat load compared to last year. So taking that, the incremental burn estimations, and combining those with some of the other structural shifts that we've seen occurring in the lower 48 demand market over the past 5 years, we get to our estimate for total gas demand in the lower 48 this summer. And right now, as you can see, we are at about 64 BCF per day of demand this summer. Even though there may be some lost opportunities due to higher renewables, overall, 64 BCF per day is a pretty large number. It's 2.4 BCF per day greater than demand averaged last year. And it's over a BCF per day greater than the remarkably strong demand year of 2012. So once again, we see 2012 as somewhat of an analog, but we actually probably would have more demand this summer than we've had in both of those years. So at this point, I want to finish out the demand side of the equation by talking about Mexico. Mexico has become a growing source of demand for U.S. produced gas. The primary driver of this is also, as with the United States, some of the power sector action. Through 2020, Mexico will be adding over 14 gigawatts of gas-fired generation capacity. Most of the capacity additions, as you can see in the chart, take place in 2016 and 2017. But in the interim, we're also seeing increased utilization of existing power infrastructure down there. At the same time, Mexico's domestic gas production has remained flat to declining in some areas. And so with demand growing and production remaining relatively flat to declining, this means that Mexico has increased its dependency on U.S. gas in order to satisfy its demand needs. So in order to facilitate that, there has been a variety of expansion projects on existing cross-border pipelines, as well as new build developments. And one of the key ones that recently came into service in January is the Net Mexico project. This is a 2.1 BCF per day export pipeline from the Agua Dulce hub in southern Texas into Mexico. And we were able to use our proprietary monitoring technologies and our data modeling to alert our clients of flows on the system before they ever showed up on interstate nominations. So moving forward, we actually are intending to expand our monitoring of cross-border flows. And this is really important because what this does is this enhances our estimation for exactly how much gas is crossing the border. So those monitored flows plus what we do see on interstate pipeline nominations are what builds our green field here, as well as a gross up value. And it also plays into our forecast for the future. And basically what we are expecting is the next 2 years we'll continue to see pretty aggressive growth in exports to Mexico, a little bit of a leveling off in the growth rate in the out years, but nonetheless persistent growth. Breaking that down, this summer we expect exports to Mexico should average just shy of 2.5 BCF per day, which would represent a 0.3 BCF per day summer over summer increase. So when you combine that with the 2.4 BCF per day increase in U.S. demand, we look at 2.7 BCF per day more demand in the market. Also, I want to touch on some of the infrastructure changes that are occurring within the United States. This summer we will see the full expansion of REX east to west. REX is already flowing some volumes east to west, picking up gas in Ohio and moving it into the Midwestern markets. That growth should see an uptick here as soon as these expansions come online, including expansions on pipes that connect to REX and will take that gas down into southern and mid-con markets. Also this summer we expect to see here, actually in just a couple days or weeks, the Rockaway lateral come into service. This will be a pretty important project that moves incremental volumes into New York City around Brooklyn. However, most of the major market shifting infrastructure projects really don't come online this summer. It's not really until we get into early winter that we're going to start to see some pretty important projects that are designed to move trapped gas out of the Marcellus into Midwestern and Southern demand zones. But nonetheless, it's important to keep an eye on these projects this summer, even though they come in at the early part of this winter. So to try and bring this all together, let's talk about where we see storage ending the season. We have one more poll question to reveal, and then we'll go ahead and we'll look at where storage should end the year. Okay, great. Anyway. All right. So as you recall, Randall was mentioning that production should run about 3.3 BCF per day greater summer over summer. Some of the supply available to the lower 48 will be a little diminished due to lower imports from Canada by about 0.2 BCF per day. So what that means is, nonetheless, we will be 3.1 BCF per day more long on supply this summer than we were last summer. On the demand side of the equation, you recall we had about 2.4 BCF per day of incremental demand from coal retirements and hydro, and we are expecting about 0.3 BCF per day more exports to Mexico. So combined, that puts us at about 2.7 BCF per day more demand this summer than last. So 3.1 of supply versus 2.7 of demand basically means we continue to remain in a long situation this summer. As you recall, we'll be starting the injection season with more or less normal inventories. So when we take our forecasted balances, what this means is that by the end of this summer, there's a very real potential that we test new records for working gas in storage. Right now, we're estimating that at the end of this summer of 2015, on October 31, we should see about 3,988 BCF of gas in lower 48 working gas inventories. Certainly, weather is going to be the big driver, and whether or not that number is actualized. A record warm summer would probably push demand higher and leave inventories lower, somewhere in the upper 3.7 TCF range. However, if we have a very cool summer and demand for gas for power generation simply doesn't manifest itself, there's the very real potential that working gas inventories at the end of the summer crest the 4 TCF level. So this is something that obviously we're going to monitor very closely. It's something we report on to our clients on a weekly basis and more frequently as needed. And this summer we expect that those estimations are going to be further enhanced. That is by our ability to monitor and estimate intrastate gas storage. So very sizable storage fields throughout Texas and Michigan that are not visible to most market participants. We have now been able to figure out ways to estimate inventories at key bellwether fields in Texas and Michigan. So we're doing this through infrared monitoring, samples of which you see on the left. And on the right, basically, is an example of how we've been able to use that and our data modeling to estimate inventories and correlate those very tightly with those reported by the Texas Railroad Commission. So that's going to help us and our clients keep tabs on exactly what the storage number is doing on a very timely and hopefully more accurate basis. But basically, with storage looking to maybe test record highs by the end of the summer, obviously, until we get major infrastructure changes, we're looking at basis prices from the west to the east and around Henry Hub at NYMEX showing continued downward trajectories. And so this is really, what you're seeing here is the summer strips as they traded in the preceding March. And prices, as you can see, have been getting perpetually weaker. And again, until we get very significant changes in demand, i.e. in the form of LNG exports or industrial growth along the Gulf Coast, and or major changes in infrastructure to move trapped gas out of oversupplied production regions, these kinds of trends in regional basis are likely to continue, at least through this summer and maybe into next summer as well. So with that, just want to summarize. This summer we expect to have about 3.1 BCF per day more supply versus last summer. This is coming from increased production, but also tempered by decreased imports from Canada. On the demand side, we expect 2.7 BCF per day more demand than last summer due to coal retirements and low hydro. A little bit of the demand is going to be tempered in the back end of summer by growth of renewables. But the overall demand number does get a boost from continued increased exports to Mexico. Nonetheless, even though demand is growing, it's not keeping pace with the production growth, and therefore injections are expected to be very heavy this summer. With inventories starting the summer at normal levels, there's a very real possibility that new inventory records at the end of summer are established. And basically, until major infrastructural changes like demand growth and pipeline reversals kick in, basis prices throughout the country should continue to soften. So with that, we do have a couple of questions for Randall and myself. Give us just a second. We're going to run through those, and we will read those out loud and take a couple minutes worth of those. Okay, so I will go ahead and take the first question, and then I'll read the next question for Randall after that. We did get a question about where the 18 gigawatts of retirements come from for this summer. That number, we started with the EIA announcement, but then we built off of that. EIA's announced retirements are typically a little behind. They're about a year old. So we augmented that number with company reports, either from earnings calls or statements to regulatory entities to build out those numbers, and then we confirm those numbers. So yes, our number does come in higher than the EIA number, but we've been able to verify through various sources plants that are scheduled for retirement that are not necessarily included in the EIA list. Okay, so this next question is for Randall. Randall, we had a question that said, how do you see Haynesville production performing for summer in the balance of 2015, especially in light of Chesapeake's CapEx cut yesterday?
Yeah, honestly, with the Chesapeake CapEx cut yesterday, don't expect they'll use any of that cut on the Haynesville. They specifically said last month on their conference call that the Haynesville on a point forward basis is some of their best economics in their whole company currently. So they've been running 8 rigs for the last almost year and a half now, and I expect them to continue to run around 7 or 8 rigs for the rest of this year. Summer of this year and balance this year, we're pretty much flat year on year in the Haynesville. I think we're actually down like 80 million cubic foot a day year on year. That's relatively flat. We're staying relatively constant at around 20 rigs or so running in the Haynesville the rest of this year, and that should help keep that production relatively flat. And speaking specifically to Chesapeake, they were about 240 million a day of production in the Haynesville a year ago, December, when they added their 6 rigs, and they're currently flowing over 800 million a day in just a year. They pretty much quadrupled their production.
Okay, we have 2 more questions. We've received a lot of questions, but we only have time for 2 more. We will do our very best to try to answer these either directly to participants or in some other form. But for now, we have 2 more questions, one for me, one for Randall. We had one question that asked, what is the biggest risk to our to our end of season storage forecast besides weather? There's a couple of risks. I think Randall alluded to the risk in the production forecast being one, that production comes in lower than we would estimate. So if that's the case, then certainly we don't face as great a potential of maxing out storage. The other is, I think obviously on the demand side, yes, demand is weather driven, but there's the potential that our demand forecast comes in, the actual demand comes in higher than our forecast. When I was estimating gas replacement for the coal retirements, it was looking at utilization rates of the to-be retired coal units and working off of that. I think load growth in certain markets could be a risk to that method. If load grows on a structural non-weather basis greater than anticipated, that could certainly generate more demand. But I would also say that a downside risk comes in the form of energy efficiency. We know that there are several markets across the U.S. where energy efficiency gains have been very effective at moderating total demand load and basically preventing gas from increasing total consumption, not necessarily market share, but total consumption. So markets like California, where when you look at demand on a weather normal basis, we actually see demand per degree declining summer over summer. So energy efficiency and demand response programs could be a downside risk to the demand forecast. And certainly if demand doesn't come in as expected, then the storage forecast will be at risk. We have one more question for Randall, and then we'll go ahead and wrap up. Okay. And then Randall, the one question we got is, what is your forecast for peak production? At what point do you see production peaking out and at what level?
So right now we have production peaking at around 73.9 and 73.9 BCF a day in the May or June time frame. That assumes that half a BCF a day that is shut in Northeast Pennsylvania that's been shut in since December 24th continues to stay shut in. Currently the prices in Tennessee Zone 4, Marcellus up there, suggest that it should stay shut in until November. When prices, forward prices go back up above $1.50. Right now they're below operating costs, and that's causing both Chesapeake and Seneca resources to shut in, like I said, about half a BCF a day. So prices in that basin get higher and get above that $1.50 before then you could potentially peak at 74.4 BCF a day if all that production came back online. But right now we're calling for peak of 73.9 in May, June.
Okay. So unfortunately, that's the time we have for today. As noted, we received many more questions, and we will do our best to get back to those that asked those. Also, would like to give a reminder that the slides and the recording of the webinar will be sent to attendees following the presentation. Please feel free to reach out to me or Randall if you have any questions. And thank you very much for joining us today.